And let me begin with Robert Reich.
Senator, I hope you can see me.
Loud and clear.
I can see you. Okay, good. Mr. Chairman, members of the committee, I'm going to submit my formal testimony for the record, and I will simply summarize. The Commerce Department reported last Wednesday that corporate profits are at a 70-year high, which raises an obvious question about inflation. When corporations are so flush with cash, why are they raising prices? Not because of the increased costs of supplies and components or of workers who are beginning to get raises because they're in demand. Yes, there are increased costs, but in a competitive economy, corporations enjoying record profits would absorb these costs. They keep their prices down to prevent competitors from grabbing away customers. But instead, they are passing these costs on to consumers in the form of higher prices. Why? Because they can. They can because they do not face meaningful competition. Since the 1980s, 2/3 of all American industries have become more concentrated. This concentration gives corporations the power to raise prices without risking the possibility of losing customers who have no other choice. Now, Mr. Chairman, you went through a number of examples. Many people see it every day. Starbucks is raising its prices to consumers, blaming the rising costs on supplies, on increasing supply costs. But Starbucks just reported a 31% increase in yearly profits. Procter & Gamble is charging more for consumer staples, also citing rising costs. But Procter & Gamble has reported a whopping 24.7% profit margin. It even spent $3 billion during the fourth quarter buying back its own shares of stock. Meat prices are soaring because the four giant meat processing corporations that dominate the industry are using their market power to extract bigger and bigger profit margins for themselves. And this is according to a report from the White House National Economic Council. Although major oil companies have faced increasing costs for crude oil, they posted near record profits last year. So they are passing those costs on to consumers in the form of higher prices at the pump and for heating oil, and they're keeping record profits. And now they're using Putin's invasion of Ukraine as an excuse to raise prices even further. The New York Times 2 weeks ago pointed out that corporate executives have spent recent earnings calls with Wall Street analysts bragging about their newfound power to raise prices, often predicting that it's going to last. Now, what are large corporations doing with their near-record profits? They are buying back their own shares of stock in order to deliver higher returns to their shareholders. Stock buybacks hit a new record last year. This year is on track to exceed it. The oil giants alone are planning to buy back at least $22 billion of their own stock. So here we have corporations with record profits, not seen in 70 years. They are raising their prices. This means consumers are paying more. Wages are rising, but almost all of the increase in wages is being wiped out by price increases. And corporations are using their profits to buy back their shares of stock. All of this, what is all of this? Connect these dots. This amounts to an upward transfer of income and wealth from consumers and workers, many of whom live from paycheck to paycheck, to shareholders, half of whom are in the richest 1% of the population, and more than 80% of whom are in the richest 10%. Now, what to do about this? The Fed is battling inflation the old-fashioned way, by raising interest rates to slow the economy. But here's the point. Higher interest rates are not going to stop corporations from using their pricing power. Higher interest rates are just going to slow the economy and potentially cause millions of lower-wage workers to lose their jobs and forfeit long overdue real wage increases. There is a far better way to battle this corporate-induced inflation that would not hurt average working Americans is for Congress and the administration to apply tougher antitrust enforcement and enact a windfall profits tax and price controls. Inflation is intimately connected to record corporate profits and widening inequality. Average working people in America are being shafted. They need and deserve action.
Secretary Reich, let's talk about policy. How did we get to where we are today with so much income and wealth inequality, where the people on top are doing phenomenally well, while ordinary Americans are struggling?
To my mind, there are three interrelated reasons. One is that corporate power keeps growing. And when I say corporate power, I'm talking about market power, corporate dominance over their markets, the ability to raise prices and not suffer any competitive loss. And we see this especially during the pandemic and now. Senator Graham asks, how can it be? Well, I'll tell you how it can be, because corporations, and they've said this in earnings calls over and over again, they're taking advantage of both the pandemic and the inflation and the war, some companies, to raise their prices because they can. They can get away with it. Now, you can call it, and we can call it whatever we want to. We can call it price gouging, or we can call it profiteering. Doesn't matter what we call it. The fact is, they are doing what their shareholders want them to do, and that's capitalism. But workers and consumers are paying the price. Another major factor is that labor has had less and less bargaining leverage. Labor unions, when I was growing up, a third of the private sector workforce was unionized. Now, 6% of the private sector workforce is unionized, which means that if you have companies that are getting more and more dominant on the one hand, and workers who are losing their bargaining power on the other, it's no surprise that you're going to see widening inequality.
Would Congress working together in a bipartisan way to do immigration reform, would that also open up the labor market and maybe put some downward pressure on prices? And I'd like each of the witnesses to answer that question.
Yes, and Senator, I do agree as well. The United States labor force is aging. I'm a good example of that. And the baby boomers are moving on. The millennials are a big generation, but the United States is going to need more workers. Immigration is and has always been a source of extraordinarily important labor market growth in America. And there is absolutely no doubt that we need to have immigration reform, and we need to allow in more immigrants.
Senator Graham?
Well, thank you. On immigration reform, I'll just tell, Dr. Reich, I know you've been involved, that if we don't secure our border first, there will be no immigration reform.
I think Dr. Reich was referring to the fact that our aging population means that to get robust labor market growth over the future, we're going to need some population growth, and immigration reform is one way to take that on.
Yeah, I'm just with Dr. Reich. You there?
Yes, I am, and that's exactly what I said, and that's exactly what I mean.
Okay, but we do have to secure the border as part of immigration reform. Is that correct?
Yes, and we have had in this country a very strong and robust debate about what securing the border actually means, just as we've had a robust debate about a lot of things. I think the central issue that we are debating today is whether we have a corporate-centered economics or whether we have a people-centered economics in terms of inflation and making sure that wages rise in a real way. And as somebody who's been involved in labor policy for the last 50 years, I can tell you that from the World War II until the late 1970s, we had a growing middle class, we had lower inequality, we had more opportunities for people in this country, and starting in 1980, we actually had a U-turn. And most Americans have not had much of a wage, if at all. but corporate profits continue to grow to the point where last week we learned that corporate profits are at a 70-year high. Now, if you can't actually explain that and explain to American public how we can possibly have inflation and price increases while corporate profits are at a 70-year high, then I just simply don't know how you can say we have a people-centered economics. We don't. We have policies coming out of Washington
Thank you.
that continue to improve the well-being of American corporations, not the
Okay.
well-being of American people.
Thank you. So I totally disagree with what you just said.
Secretary Reich, you've said that corporate profits are at a 70-year high. My recollection from my economics classes is that competition would drive prices to at or near the marginal cost of production. That does not seem to be happening, and there are two markets in which it seems particularly not to be happening. One is the oil market, and the other is the meat market. Is there something unusual about those two markets that seemingly causes this market theory not to pertain in those markets?
Well, Senator, you have both in the oil market and in the meat market a relatively few number of producers who can easily coordinate their production. It's called oligopolistic pricing and oligopolistic coordination. And we see it not just in oil and in meat. I want to emphasize that since the 1980s, 2/3 of all American industries have become more concentrated. And you look across the industries, particularly where you see the greatest inflation, and you see the fewest number of competitors dominating the industries because they can raise prices even though they are highly profitable. That is a core problem today.
What would you say is the role of the international oil cartel and speculation in driving the recent surge in oil prices?
The international oil cartel and speculation typifies the kind of oligopoly, that is, the relatively few number of players who coordinate prices and production that we see. And again, it exemplifies the problems of oligopoly. That is, when you have producers who are able to coordinate prices and production, inevitably they are going to do what their shareholders want them to do, and that is to maximize profits. And then they're going to turn around and they are going to do again what their shareholders want them to do, which is to buy back their shares of stock to raise and maintain the highest possible share prices. That is probably good for their shareholders. But what is good for shareholders, we see time and again, is not necessarily good for the economy or good for consumers or good for workers.
Mr. Wright, what do you think about $45 trillion worth of debt? Do you think that we can afford it?
Well, I think that we could afford it, but there are two necessary prerequisites. One is investing in the American people, that is education, infrastructure, making sure that people have what they need to be more productive. That's what we've done for much of the post-war era. We stopped doing it. It's very important that we resume doing it. And secondly, I think we have to raise taxes on the extraordinary wealthy and also on big companies. And for Congress to fail to do that at a time when we have unprecedented corporate wealth and income, and also individual wealth and income at the top, not ordinary people, I'm talking about at the top, there is extraordinary, it's an opportunity to get our fiscal house in order. And for Congress not to take this opportunity, I think would be a shame.
Secretary Reich, let me just ask you to talk a little bit about the connection between those Trump tax cuts and ongoing stock buybacks. So, Secretary Reich, if you could start by just talking about what the incentives from that bill, what created and what we're still living with.
Yes, Senator. We were promised, the American public was promised, you recall, before the Trump tax cuts, that everybody would get a raise, a wage raise, and that there would be a huge new round of investments in America. Neither of those came to pass. Instead, corporations used their The money that they otherwise would have spent, otherwise would have been taxed, the revenues they actually spent on corporate buybacks. I think it's important to understand that stock buybacks do not generate more productivity in the economy. There is no trickle down from a stock buyback. When corporations use their record profits, as they're doing right now, to buy back their own shares of stock, what they're doing is delivering higher returns to their shareholders, because buybacks reduce a company's shares outstanding, pushing its profit per share figure higher. They hit a new record last year. They're on the way to hitting an even larger record this year. It helps the share price, but it amounts to a redistribution from workers and consumers to shareholders. Because in an inflationary environment, as we are in right now, when highly profitable companies are using their profits to buy back shares and they are raising their prices at the same time, what happens is consumers pay more. Workers, even if they've got a raise, are losing those raises because they're losing them to inflation. And shareholders do better, but as we all know, most shareholders, half of this stock market is owned by the top 1% of Americans by income, and 84% is owned by the top 10% of Americans by income. This is how you get the redistribution upward.
Can you spend a minute talking how a windfall tax can help counter the outsized power of these large corporations and reduce inflationary pressure?
Yes, Senator, and I think it's very important. A windfall profits tax is exactly what is needed right now. When oil companies, for example, are showing, as they are, historical profits, they are making huge amounts of money. They are raising prices at the pump at the same time. They don't need to raise those prices. They could easily absorb any cost increases, but they are not absorbing those cost increases. They are instead, as you pointed out, they're taking their huge windfall profits, and they are buying back shares of stock to help their shareholders and executives. And so people are going to the gas pumps. They are spending their own money at very, very high and rapid rates to fill their gas tanks, and that money, a large portion of that money, is going to executives and major investors. So you want a windfall profits tax that stops them from doing that and actually rebates that money to consumers. It's we did it in World War II. We did it in World War I. We did it under emergency circumstances. There's no reason we should not be doing it now. In fact, there's every reason we should be doing it.